True wealth is rarely built by chasing the most popular stock on the market. And while Nvidia gets the headlines, Eaton gets the backlog. The companies that build the unglamorous foundational infrastructure powering the AI revolution often offer the most durable and predictable investments. But the market is already pricing the stock at 29 times forward earnings. That's a steep premium even over the chipmakers themselves. So let's run the numbers to find out if Eaton's massive pipeline actually justifies the premium price tag. Because Eaton just closed June with a 24.1 billion order book. This is a record high, and the shape of it actually says more than the pure size does. Now, if the name Eaton means nothing to you, that's rather the point. Because Eaton makes the unglamorous hardware that sits between a power station and a computer. Switchgear, circuit breakers, transformers, busways and backup power. None of it sounds sexy or carries a logo you'd recognize. But all of it has to be bought, delivered and installed before a single GPU can be switched on. When we split it by division, Electrical Americas, the North America electrical business and the biggest segment of Eaton, grew its backlog 33% year over year to $15.2 billion. That's $3.8 billion of new work added in the last 12 months. Electrical Global, the international part, even grew its backlog 103%. It more than doubled, and orders are running the same way. On a rolling 12-month basis, organic orders internationally are up by 33%, and in the Americas were up by 41%. The book-to-bill ratio in the Americas segment even hit 1.3 times, which means that for every dollar of revenue Eaton recognizes, it signed up $1.30 of new work. So their pipeline of orders is filling faster than the company can deliver. When we narrow this down to data centers, it looks even better. Their data center sales grew about 65% last quarter and their data center orders by about 85%. That isn't Eaton getting lucky. The bottleneck in building AI capacity stopped being silicon a while ago. It's electricity and everything that moves it. You can buy GPUs in months, but you wait years for a grid interconnection. Large power transformers and switchgears even have lead times of multiple years. And the industry is now moving to 800 volt DC power delivered straight to the rack, which means that more or less everything between the substation and the server has to be rebuilt. And Eaton sells into every layer of that. So the demand is real and it's Eaton's. Nvidia takes the headlines, but Eaton takes the purchase orders that makes those headlines physically possible. Which leaves one question for anyone thinking about investing in them. Because everybody who read the earnings release already knows about the backlog and the order book. So what is the market already charging for it? 29 times earnings on a forward-looking basis. Nvidia, on the other hand, only trades at 22 times. Now, that might seem strange at first glance. A switchgear company is about a third more expensive than one of the quickest growing AI chip companies on Earth. But that comparison depends on which numbers we look at. So here are both. Look backwards over the last 12 months and these two cost roughly the same. Price to free cash flow, Eaton 44, Nvidia 44.5. EV to EBITDA, Eaton 29.8, Nvidia 31.4. The reason for this is that the market expects Nvidia to grow into higher trailing 12-month multiples over the next year. It doesn't expect the same from Eaton. When we adjust that for growth, the gap widens rather than closes. On a next 12-month PEG, the multiple divided by the expected growth, Eaton sits at 2.8. Nvidia sits only at 0.6. Eaton is roughly 5 times more expensive when we consider the expected growth. Of course, that number needs Nvidia's analyst estimates holding up, which is a real dependency, but the gap is wide enough that no sensible set of estimates closes it. But why is this? Why is the price of a boring old electric components company more expensive than Nvidia's, and what does it imply? We can find this out by running a discounted cash flow analysis backwards. Instead of estimating the growth and solving for value, we can take today's share price and solve it for the growth rate that justifies it. The answer is about 23% free cash flow growth every year for the next 5 years. Eaton itself guides 11 to 13% organic revenue growth for this year. This is also in line with what analysts expect. So the price assumes a growth of roughly double of what the company itself is telling you to expect. That isn't a forecast I am making. It's calculated from the stock price. And the forecast tells you that the premium isn't being paid for growth. Eaton's growth is right there in the guidance, and it's not 23%. That premium is paid for something else. You are paying for visibility, because the 24.1 billion order book is future earnings you can already see arriving. They are signed, scheduled, and difficult to take away. That's a durability premium, and it's kinda justified. Because a company with years of contracted work already in their hands is worth more than a company that starts every quarter from zero. And Eaton expects 71% of that backlog to convert into revenue within the next 12 months. 71%. So of the 24.1 billion, roughly 17 billion shows up inside the next 4 quarters. That leaves about 7 billion beyond that. That's less than what Eaton books in a single quarter of sales today. For a company that is usually regarded as having long cycles, the cash flow profile isn't showing it. Now, of course, a fast conversion is a sign of strength, not weakness. It means that orders are being turned into revenue quickly, and a book-to-bill ratio of above 1 says the pipeline is refilling faster than it empties. But that changes what you own. The reverse discounted cash flow wants 23.4% free cash flow growth a year for the next 5 years. The order book already covers more than one of those years. The other 4 are orders nobody has placed yet. So the market is paying today for a book-to-bill ratio it can't see yet. And the backlog only tells you that the revenue is coming. It says nothing about how this revenue converts into free cash flow. And on that, Eaton's numbers just moved the wrong way. But before we go there, if you like the analysis so far and think that it helps your own investing, hit subscribe. I post up to 2 of these deep dive analyses every single week. Their operating margins last quarter were 17.7%. That's down from 18.8% from the same quarter last year. On a revenue that is up by 21%. That 21% more revenue is supposed to make a manufacturer more profitable, not less. Fixed costs get spread over more units, plants run hotter, the margin lifts. That's the entire logic of buying an industrial compounder with a growing order book. So let's take a closer look at the 2 main divisions and look at what each one earns. Electrical Americas ran at 27.5% operating margin last quarter. Electrical Global ran at 19.8%. That's a difference of 7.7%. Same company, same quarter, and 1/2 of the electrical business earns nearly 8 points more on every dollar than the other. Now, let's put that next to the backlog. The division growing its backlog 103% is Global, the one earning 19.8%. The division earning 27.5% grew its backlog by only 33%. So the growth is landing 3 times over in the lower margin half of the business. Now, Eaton has never said that the data center business has lower margin, but it looks that way from their numbers. The part of the business that's growing the fastest earns less per dollar than the other parts are. Their management doesn't frame any of this as a mix problem though. On the earnings call, the Americas decline gets put down to commodity price and wage inflation plus higher intangible amortization. And they called it only temporary. Now let's look a bit more closely at the last one. Because amortization doesn't climb on its own. It climbs when you buy something. And Eaton bought Boyd Thermal. That's liquid cooling for AI racks. And they paid $9.5 billion in cash, and the deal closed last quarter. Eaton itself expects that this will start contributing to their adjusted earnings in year 2, meaning 2027, not now. And it was paid for with borrowed money. Net debt went from $9.7 billion to about $21 billion. The net debt to EBITDA ratio increased over 3 times, and the interest expense in the quarter was 201 million against 71 million a year ago. So when we look at the company's bottom line, something interesting happens. Even though the revenue is up by 21% on a year-over-year basis, the EPS is even down a bit at the same time. Now, Boyd's liquid cooling business is exactly the AI rack business the order book is full of. So the backlog as well as the debt come from the same market. You just wouldn't get the full growth story without the debt and the delusion that is attached to it. But that leaves the expansion the market is paying 23% growth for, still somewhere in the future. So where shall it come from? Eaton's full-year guidance calls for segment margins of 24.1 to 24.5%. The first quarter came in at 22.7, the second quarter at 23.1%. Segment margin is the profit from the operating business itself, before corporate costs, interests and acquisitions accounting. It's the number Eaton guides to, so we should also take a look. And in the first half year, they averaged at 22.9%. So to land inside their guidance range, the second half of the year has to average somewhere around 25.5%. That's roughly 250 basis points above where the company is running today, in 6 months. And when Eaton reported Q2, it raised their organic growth guidance to 11 to 13%. But the margin guidance for the year was left exactly where it was. So more revenue, same margin promise. And the answer for how they want to get there is Electrical Americas, which they guided to close to 30%. And the margins here already moved 190 basis points higher between the first and the second quarter. Their CFO broke it down. About 100 of those points were price versus costs, and the other 90 were pure output. Now, let's look 1 year further out, because something else is going to happen to this margin line. Eaton is separating its mobility business. That's their vehicle and e-mobility business in the first quarter of 2027. Mobility earned 13% in margins last quarter, against a group average of 23.1%. That's by far the lowest margin division. So when you take that out of the mix, the group average rises by something close to 110 basis points. And nobody has to build anything or negotiate a better price with the supplier. The number just goes up because the calculation changed. And Eaton also collects about 1.1 billion in cash on the way out. That's active portfolio management, and I like that they do it. But it isn't improving operations. And the timing is important too. Mobility separates in 2027. So it contributes nothing to the margin climb that is expected for this year. All of that guidance has to come from running the actual business better in the next 6 months. But let's for a moment suppose they do it. Electrical Americas clears the 29% margins they've guided, and the overall segment margin lands inside their 24.1 to 24.5% guidance. There is still a bigger objection. Eaton should trade at a premium to Nvidia. Not despite the comparison, because of it. Eaton sells into power grids, utilities, data centers and aerospace with contracts spanning multiple years and an aftermarket that keeps earning long after the equipment is installed. Nvidia sells chips into a build-out a handful of customers can slow down whenever they decide to. One of those earning streams is more predictable and safer than the other, and predictable earnings are worth more per dollar. So the PE of 30 times for Eaton against 22 for Nvidia isn't a mispricing. It's the market doing its job. That's a strong argument, but I think it's only half correct. Yes, durability deserves a premium. But where it weakens is the assumption underneath, that Eaton's earnings are as steady as the story needs. 2 tests this century say otherwise. In 2009, their revenue fell by 23% and their earnings per share by 62% even. And in 2022, we have a similar picture. Revenue went from 21.4 billion to 70.9. EPS 5.25 to 3.5. And those aren't the numbers of a business that sits out of the cycle. They are the numbers of a very good industrial having a bad recession, which is exactly what Eaton is. And this is the thing most people have backwards. When earnings swing with the cycle, the market discounts them. So a multiple looks cheapest exactly when investors doubt the earnings underneath it. A low price to earnings isn't automatically a bargain. Sometimes it's a warning sign. I made a whole video on why that trap catches semiconductor investors so often. I'll put it in the card up here or maybe here, and also in the description if you want to check it out. But I am not telling you where Nvidia sits in its own cycle. I don't know, and I'd be very careful with estimations, especially because many analysts currently think that the AI cycle will be different from a normal one. I can only tell you that the risk is real, it's hard to price, and that's exactly why Eaton's premium isn't absurd. But almost 3 times PEG is also a lot to pay for earnings that fell 62% in 2009 and another 19% in 2020. And the thing that would justify paying it, operating margins expanding as the backlog turns into revenue, is the one thing moving the wrong way despite the guidance on sector margins. So Eaton has a very strong business that is also benefiting from tailwinds. But what actually is the fair value of the company? Let's take the same discounted cash flow model as before and run it forwards this time. And even though the expected margin expansion hasn't come so far, let's still assume it will, and with it, the free cash flow will compound by 16% a year for the next 5 years. Not the 11 to 13% the company itself guides, 16. So these are rather optimistic assumptions. And with these assumptions, the fair value comes out at $333 a share. That's 27% below where the stock trades today. With optimistic assumptions, we don't even need to look at the sensitivity matrix or the bear case. You don't even need to believe that the margins will stay under pressure or that the backlog disappoints. Even the optimistic calculation for the fair value doesn't come close to today's price. So the business is real, the demand is real, and the order book proves it. And for a long-term investor that just wants to buy a high-quality business and forget about it, the company would be a good choice. Because the longer you own an investment, the less the entry price matters. And over a 10-year horizon or even longer, I would rather own the company that electrifies the AI build-out than to guess which chip wins. But you're being asked today to pay for a margin expansion that hasn't shown up in the numbers yet. And parts of this come from selling a division rather than improving the operations. That's not a reason to be bearish for Eaton. It's a reason to care what you pay for. Now, I would like to hear from you. Are you already invested in Eaton? And which company would you like me to analyze next? Let me know down in the comments. And if you would like to know why Rolls-Royce's latest upgrade actually hides a decline, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.